telling me that you have a way to defer the tax situation there? Is that what you're telling me?
Yes, absolutely. Yes. And so the first one I was referring to is a 1031 exchange, which only applies to investment real estate. The second one I'm referring to is called a deferred sales trust.
A real eye-opener to see that there are ways that people can use the regulatory framework, if properly structured, to invest 1031 exchange dollars in things that you would not think were like-kind to what they exited from. So it was very impressive. I got to say, you are the first one I've seen pull this off, and I'm pretty hesitant to believe in a lot of these kinds of things. So it's a major feat for me to say, wow, this actually really worked, and it was really cool.
1031 is a way to shelter your income when you sell the thing. The DST is a way to avoid the 1031 and not have to suffer the time penalty.
Our career and during different tax periods, we've seen, these tax avoidance, tax minimization, offshore, all these different strategies undertaken to minimize or avoid taxes. And then I can tell you that, some of them are just not worth the trouble. And so I was skeptical. Admittedly, I was skeptical. I thought, oh yeah, here we go, another one of these, right? And then they say, no, it really is different, right? So look more closely. We looked more closely. We had, honestly, 2 years of conversations. 2 years. Now we were being due diligence at the same time that we were doing due diligence, but 2 years is a long time to be, sort of flirting with the idea of and getting to know the people and getting to really understand the transaction. Yeah, long story short, we got comfortable, although we are not tax attorneys, lawyers, or estate planning attorneys, that at least, from an investment perspective, that, it made sense to sell a highly appreciated asset, get liquid, hold that in this type of a deferred or installment sale type of instrument, and then just be in a position then to do the most important thing. I'm probably stealing your next question, which is time. They say, well, you can't make more time. You can. The Deferred Sales Trust, in a way, allows you to lengthen the investment time horizon for those assets after getting liquid, but before having to feel the tax impact. And from an investment manager's perspective, time horizon is the most important element in investing.
All right, everybody. Hello. Welcome to another Mastermind, Deferred Sales Trust, Capital Gains Tax Solutions Mastermind, where we believe most high net worth individuals and those who help them, they struggle with clarifying their capital gains tax deferral options, and not having a clear plan is the enemy. And using a proven tax deferral strategy such as the Deferred Sales Trust is an amazing way, if not the best way, for you to exit highly appreciated real estate, businesses, cryptocurrency, so you can create and preserve more wealth. Also other appreciated assets as well, public or private stock, LP interest, GP interest, captive insurance, you name it. If it has capital gains tax, we can defer it as long as it's big enough, typically 1 million net proceeds, $1 million gain. We are here to help you clarify the problem. And the problem typically is this 25 to 50% in capital gains tax and depreciation recapture. And then clarify your goals. Why are you selling? What is the outcome? What is your B, right? What are you trying to accomplish? And where are you at today is your A. And that gap is oftentimes that tax of which you're, having to pay or will have to pay if you sell. And what would it mean if we could defer that tax and we could use the wealth that you owe to the government to build more wealth, to build more cash flow, to give you opportunities to give more to the charities that you believe in, to give you opportunities to retire, maybe to start that new business venture, whatever it is that you're trying to do. We want to help you to accomplish that. We want to be your guide. And we want to become a part of your dream team. As a part of that dream team, I am joined by some of the best in, I think, their particular niche industry. In particular, one of my strategic alliances, one of business partners, his name is Jake Miller. He is the CPA Whisperer. He is a financial advisor. He thinks on a whole nother level. Jake, how are we doing today?
Doing very well, Brett. Thank you for the introduction.
I think you're on mute, Jake, so I can't quite hear you. I may have to switch your microphone. He'll be in here in a minute. We are happy to talk about the vision of why we're here. but also we'll talk about the deal close story of the week, the escrow of the week, and then we're going to be doing some role playing today. We're trying to do something a little bit different for everybody, where we're going to become the client or the CPA or the skeptical CPA or the cautious advisor on the side, and we're going to do Jake and I are gonna have some fun with this. That was by request of last week, so we're excited to do that. And in fact, maybe actually was my speakers, Jake. Let me actually switch this over. Jake, can you talk again? I think actually I had you guys on mute. Can you talk?
How about that? Can you hear me now?
Yeah, it was actually my fault. I'm sorry. You sound fantastic. Jake, how you doing today?
Doing wonderful. Now that you can hear me, I'm doing so much better.
Excellent. You got the goatee today. It's looking good. It's looking debonair, clean, classy, but good. I like it.
I had a little bit of Colombian grooming while I was down there. I just got back last night. So finally here in Utah, back with the family and here at the house, and ready to keep things rolling.
Fantastic. Well, glad to have you again. And give a little bit more. I talked a little bit about the vision and why we're here, but I think it's good to hear it twice from your perspective, Jake. Why are we here? What's kind of the problem? And then what are we going to be doing today?
Absolutely. So a lot of times individuals have found that they need to kind of level up the advice that they're getting for these very uncommon, when I say uncommon, infrequent transactions that they have where they're selling highly appreciated assets. So it's not every day that they're going to sell their business. It's not every day that they're going to sell the house that they've lived in for the last 20 years. It's not every day that they're going to sell that warehouse, that multifamily, that crypto, that whatever. It's not every day they're going to get a warrant in a reverse IPO. I mean, all of these examples of people that we've helped, right? And because it's not every day, they have to use people that they don't use every day to help them with the transaction. That's why they reach out to us. We're the experts when it comes to highly appreciated assets and how to help them make that transition without recognizing it for tax purposes, utilizing the Deferred Sales Trust.
That's so well said. By the way, you can learn more about Jake Miller at strategictaxsolutions.com. That's strategictaxsolutions.com. You can learn more about the Deferred Sales Trust, capital gains tax solutions.com. Either way you go, you'll be connected with both either of us, and we connect with one another. Yes, so excellent, Jake. That's very well said, right? Because it is infrequent, and oftentimes there's folks that are, they're CPAs and they're specialized, but they're specialized in more of the general practice of tax returns and maybe depreciation schedules and doing more of the reactive, what happened, and let's account for that, and let's lay that out in a tax return so we're properly paying the right amount of taxes. Maybe some tax planning, but oftentimes they're not, the ACL knee specialist, if you will, in that analogy, where they're repairing the ACLs, and that's all that ACL surgeon's doing, right? They're not doing the general practitioner work. So talk about the nuance and the specialty with the tax attorneys that are our business partners that we work with, that it takes to focus, and what that means for the client.
So in this step, a lot of times people are getting organized because they're coming up on an opportunity. The opportunity may be the right time for the sell. It might be the right time for the exit of their business, but it may not be the right time to pay the taxes, right? So with that type of planning in mind, where some of the things match up correctly, but not all the stars align, we need a different tool, a tool that puts control of timing back in their hands and allows them to take control of if and when they take constructive receipt of those funds, which is why we capture and we interject the trust in between them and the transaction, and we capture that transaction and we defer it forward, allowing them to invest it in the meantime and to grow it and overall increase the future cash flow. And which, Brett, I like your shirt today. It's all about the tax flow and not just the cash flow, right? That's the message that a lot of times we're trying to send out there, helping people understand that at the end of the day, it's not always the sales price that matters. And it's not always the net proceeds that gets transferred back onto the client, but it's the net after taxes that they're able to actually spend at the end of the day. And if we can put that control over timing and that control over taxes back in their hands, it becomes a very powerful thing.
Absolutely. And I'm going to share my screen here and kind of give just some the basic benefits of the deferred sales trust. And, part of that is absolutely the tax flow planning. And tax flow planning, we also, we always talk about, cash flow and what that means. But guess what? The problem is the government's an all-time spending. In fact, they've spent more money and increased the debt in the last 2 years than perhaps the last 40. I don't know the exact stat, but it's incredible the amount of money they're printing and they're spending, and they're out of control. And what that means is taxes are likely to go up, and that's a problem. And so it's not just about your cash flow, what you actually receive and earn, but it's your tax flow. It's always been about both, but more importantly, the scales are starting to shift more and more. And so one of the benefits of the deferred sales trust, and it's actually benefit number one, is buying back in and out of real estate, which can provide some depreciation that can offset the tax flow. In other words, it can decrease your overall cash flow, taxes on your cash flow, because to the extent you have depreciation dollar for a cash flow dollar, it can be offset. And so one of the disadvantages with the 1031 exchange is that it has an old schedule of depreciation, which means you have less tax flow, less tax flow or depreciation to offset your cash flow. And so now the key is optimal timing, right? We want to say you can do it when it makes sense for you, right? And that's where step number 2 comes in that you can diversify and put your funds into a diversified investment grade securities, some of the biggest companies in the world. You can pay off your debt. We call it the Dave Ramsey debt-free plan. We believe now more than ever, it's the time to sell these highly appreciated real estate or businesses, or even highly concentrated cryptocurrency or stock positions. Diversify your wealth into some of the biggest companies in the world, the Amazons, the Googles, the Netflix, the Costcos, and to have a kind of a preservation play here, at least to see before what happens. We don't know what's going to happen, right? But if you can be in some of the biggest companies in the world, guess what? That's fantastic. Now, that doesn't necessarily mean you can't get back into your other deals, but here's the key. You can dollar cost average into those deals versus a 1031 where the whole entity and the whole amount of equity typically goes into one single asset in one location, one property. And that's the opposite of diversification. And we believe that liquidity and diversification with the ability to work with someone like Jake Miller is an amazing way to create and preserve more wealth. All right, the number 3, by the way, is separation of partnerships, right? So remember, the deferred sales trust can sever partnerships, whereas the 1031 exchange, typically the whole entity must move. In fact, just closed a $48 million property in Las Vegas for 2 GP clients. This is their 5th deal they've done with us. And they were looking for some tax deferral, but they were also separating the partnership. And, they had a lot of LPs that they were exiting paying their tax. Actually, one LP ended up doing the deferred sales trust. And then as the 2 GPs, they had to have their own deferred sales trust. So that was a really nice way for them to not feel like they have to keep going with that partnership. As well, this can save a failed 1031 exchange. Now, we continue to save these. By the way, there's accommodators out there that don't want you to know about this. So make sure you're working with us so we can get you accommodators that actually will accommodate. Okay, but we can rescue a failed 1031 exchange. No, you do not have to identify it, the deferred sales trust, because it's not a property. Remember, it's an installment sales strategy that can be an alternative or a backup plan in case your 1031 fails. Now, Jake and I also recently did a deal where we did a partial Delaware statutory trust and a partial deferred sales trust. So realize too, the deferred sales trust is very friendly. It's friendly to 1031 exchanges. It's friendly to the Delaware statutory trust. And it can be that gap or that bridge between, let's say you sold a $10 million asset and you found a perfect $5 million, but you have an extra $5 million to place. Well, why don't you put that extra $5 million into the deferred sales trust, and therefore you can defer all of your tax. The next, I think one of the most important benefits of the deferred sales trust is converting an illiquid asset. Again, I talked about this a little bit, but something like a primary home or a business or commercial real estate, right? They're illiquid, they're not diversified, and perhaps you even have some debt on that, to a debt-free, diversified, liquid investments in some of the biggest companies in the world. And then number 6, which is often overlooked and, perhaps just reserved for those of the ultra high net worth, but you can move funds outside your taxable estate, eliminating the 40% death tax, which Jake, talk about that. What's the death tax? What does that look like for everybody right now? And who actually needs to be concerned about that?
Pretty much anybody and everybody that has assets right now, currently today, of over $24 million. Anything above and beyond that will be subject to the death tax, which is an additional 40% of your assets that you would otherwise wish to pass on to your legacy. Now, there is a sunset, meaning the Tax Cuts and Jobs Act, which is going away after 2026. And Brett, do you know the number that it's going to drop down to after that?
I believe it's set to cut in half. So 12 million single, about 12 million married, 6 million single. But I also heard rumbles of even lower than that.
Yes. And so it's going to be reset back to what it was originally. And that is perhaps the best case scenario of what it could be, subject to legislative changes. So here what we have is something that, if you're passing away in the next year or two, then, you get the advantage of the higher limit. But if you're doing estate planning and you pass away in 2026, then those numbers get cut in half. And of course, at any time, Brett, until they lock in like another 10-year period, like we did with the Tax Cuts and Jobs Act, that number is subject to change. And in fact, it wasn't maybe 20 something years ago, maybe it might have been as much as 28 years ago. It was only 600,000, not millions, but 600,000. So anything above and beyond that was kind of like a little mousetrap, or a really big mousetrap of the IRS, where they could capture big chunks of the money during some of the largest movements that will exist in our era, which is the transfer of legacy from one generation to the next.
Yeah, and let's talk about that, because this is so important, and this is part of why we're here. We want to let you know that our mission is beyond just helping you create and preserve more wealth and defer tax, but it's actually a bigger message of freedom for U.S. citizens and the wealth of America. Literally, the biggest wealth transfer in the history of the planet is happening right now. And so the baby boomers, and in fact, according to the American Bankers Association, a bunch of other studies, there's about $32 trillion that's going to transfer from the baby boomers to the millennials in the next 18 to 20 years. Again, this is known as the largest wealth transfer in the history of the planet. In fact, there's 10,000 baby boomers turning 65 every day, and there's about 77 million in the U.S. alone. And in fact, 50% of the total net worth in America total is primary homes, businesses, private equity, and commercial real estate. And so you think about this, if this $32 trillion, Jake, is if it's going to be in the government's hands, or is it going to be in the people's hands, right? And guess where the control and the lack of freedom comes? It's for those that can control capital. Okay. Now we're on a mission to use every legal way to keep the capital inside of the people's hands, we the people, right? And that's part of the tax flow game as well. It's not just offsetting, some taxes and saving a little bit here. It's literally who's going to be in control of this wealth, right? And is it going to be with your kids and your heirs, right? With this 40% elimination of the death tax using the Deferred Sales Trust Plus, or is it going to be in the government's hands when they take this 40%? So these are the stakes that are at hand, and we need everybody who can understand these things and take advantage of these things and use these things to get with us. And that's why we're here. We're trying to create a community. We're trying to create clarity on the problem, create direction, and we're going to try to show you our skill set to help you execute on this. And this community is growing. We continue to have more people add every week. But that's why we're here. So that being said, Jake, we talked about doing some role playing this week for everybody. And then we're going to open up for questions for everyone as well. Are you ready for the role play, Jake? And by the way, we didn't even prep for this, so except for what we said last week. But what do you think, Jake? Do you want to be the client first, or the skeptical CPA, or the cautious financial advisor? What would you like to be first, or would you like me to be that person first?
So I'll be the client first, and you'll be Brett Swarts. You'll be the trustee.
Okay.
Right. We'll go with that. But first and foremost, I wanted to mention something about the Advocates Creed. So early on in the industry, back in 2008, when things got started for you in such a big way, and they got started for me in such a big way, and the rest of the world, there was the calamity. I mean, literally with the crash. And you had, videos of people on Wall Street jumping out of windows and all kinds of terrible things, right? And that's like when we were essentially born in the industry, so to speak. That's like when things happened. And I joined a firm at the time that, from a fiduciary standpoint, we had to memorize an advocacy creed. And all it did is it talked about doing what's right, and how you got to help your clients make conscious, deliberate decisions rather than leaving life to chance and good luck. Anyway, so at the end of the day, it just comes down to this. If you fail to plan, you're essentially planning to fail. And the job of an advisor is to make sure that you do plan, not fail, but that you plan and that he or she is there for you to help you make those decisions that you wouldn't otherwise make that are in the best interest of you and your family and those that you care about. So,
Absolutely.
So with that being said, I'm going to be this client who's really good at what the client does to make money, but maybe not really good at everything else.
It sounds good. All right, sounds great. So, are you calling me? What did you already see me talk somewhere? Is it on a webinar? Did you read the book? Like what? Give me the context. So, hi Jake, what's going on, man?
Hey Doug, member of EXP. He told me that I need to come talk to you. He says that you've got this thing, some kind of miracle trust that can do it all, and I just want to hear more about it because I'm thinking of selling my house. I'm very fortunate. I only spent $1 million, and I'm selling it for $5 million. And I'm kind of calculating what I'm going to end up with after taxes. I understand that I just need to pay a lot. I live in California, but Doug says I don't really have to pay as much, and that's probably not lawful. But I like Doug, him and his wife. They're good people, so I'm here talking to you now.
Excellent. Yeah, I love that. Doug's fantastic, really smart guy, and I'm glad he connected us together. So can you tell me a little bit more about your scenario, though? You said is it a primary house? Is it an investment house? You said $5 million. Do you have the basis and the debt?
I've been living in it for now. It's been quite a while, and actually inherited it from my parents. All right. I believe at the time that I inherited it, maybe 10 years ago, it was probably worth 700. And, I did this little thing in the estate and I paid $1 million, just to everybody else to make them happy. So I paid a little bit more than it was worth. I don't know if that complicates it or whatever. But anyway, at the end of the day, I put in $1 million and I'm going to sell it for $5 million. And I've been living in it ever since. I'm told I can't do a 1031. And I'm just figuring, it's such a good windfall of money. I shouldn't be greedy, right?
Yeah, well, maybe. Well, so your adjusted basis is about $1 million, if that's what I'm hearing you right. And you didn't put any improvements into the property. Is that a fair summary on the adjusted basis?
Yep.
And how about your debt? Do you owe anything on it?
Nope. Free and clear. Yeah.
All right.
Do pretty well for myself. I'm always in the highest tax bracket anyway. So it's all paid off.
Okay. So $5 million minus $1 million is a $4 million gain, right? In the state of California, you have state and federal. And so you have at least 33% because state is 13.3 and federal is 20. There might be an Obamacare tax, although typically that's only subject for that. I've heard it two ways, only for investment property or business purposes, right? But the other way could be your CPA could say it is. But so we're going to use 33 to be on the conservative or the liberal side. So about $1.32 million of tax. Is that a fair number to use? That's the liability, 1.3. Is that fair?
Yeah. I was looking between 1.3 and 1.4 that I'd end up losing to taxes.
Okay. So on a scale of 1 to 10, how serious are you about deferring that tax? Or it's just kind of like, you can just pay the tax, no big deal.
Well, right now, I just don't believe it yet. So I think that I have to pay it.
Got it. But on a scale of 1 to 10 of paying that tax, what's the pain? Does that cause like any pain, or do you have any, because some people I talk with, Jake, they're like, I loathe paying even $1 tax, $1 million tax. I can't even think about, like, this is, all of the good that we could be doing with it, all the wealth we could be creating. I can pass it to my grandkids and we can keep it going. Like, so on a scale of 1 to 10, what does this $1.3 million of tax mean to you?
You know what? I'm really here because my wife said I need to come talk to you, Rhett. Doug sent us to you, but it's really her idea. She doesn't want to pay the 1.3, the 1.4.
Okay.
She thinks we could be doing other things with that. She keeps talking to me about a boat, So, whatever we can do to maybe make her happy, if it's real, if this isn't just a magic trust.
Got it. All right. So you might want to spend some of it on some fun stuff. And to the extent you want to spend it on some fun stuff, that's totally cool. That's just taxable. So we have a really unique skill set where we allow people to take advantage of, or we show people how to take advantage of something called a deferred sales trust. We wouldn't call it a magic trust. It's actually just an installment sale. And the way it works is you can loan this $5 million to the trust at close of escrow. And instead of paying the tax, you can keep it deferred, okay, until you start receiving payments from the trust. But again, if there's got to be that pain, you got to really want to have that $1.3 million working for you for 10, 20, 30, 40 years, pass it to your kids. They can keep it going. They can pass it to grandkids. It's got to mean something. But if there's not a lot of pain and like motivation to not have to pay it right away, or if you want to just spend it on a primary home or a boat, then it's probably not a great fit for you, Jake.
Now, here's my question though. So my wife, she's a little extreme. She kind of enjoys the outdoors, and she actually owns a rec and tourism business. So, I mean, she doesn't plan on taking me out on the boat, right? I mean, she's going to be taking clients out on the boat.
Oh, so if you want to do like a business with the boat, that is cool. Like you can actually partner with the trust. And so you could have the 5 million in there and you could partner, let's say it's a $2 million business. You're able to defer the tax and start new businesses and do, it can be a boat business, it could be a car business, it can be real estate business. As long as it's some kind of business purpose. You see, the government gives us these opportunities to create more, even not only more wealth for us, but really more tax revenue for them. And this is why this thing works. So what questions do you have so far, Jake? If you could defer the 1.3 million of tax, you could start the business with the boat. Is there anything else that you'd like to learn about the trust?
So with the magic trust, as you call it, Brett, you're saying I don't have to pay the taxes.
And so you can defer the taxes. So think of it like, if you want to use the word magic, let's think of like a magic IRA or a magic 401k. Do you have one of those, Jake?
I have lots of magic tools, yes. And
cool.
IRAs, SEP IRAs, deferred comp plans, all kinds of fun things.
Yep. So those are all kind of like magic, if you want to use that term. And the magic meaning that it's just a deferral state, and you'll pay taxes as you receive payments from those in different at different times when you receive it. Same thing here. As long as we keep this 5 million in this deferred sales trust, you're in a deferral state. And to the extent that you pay interest off of the trust, you'll pay tax. To the extent you dip into the principal, the 5 million, you'll pay capital gains tax. And so it's just, think of it like a delayed tax trust, kind of like a delay IRA account, right? You're delaying the tax in the IRA, you're delaying the income in the IRA, you're delaying the same thing with the trust. A little bit different in that it's an installment sale, but that's all it is. And the government's happy to allow us to do it so far.
Well, very good. Now, so we're going to use this deferred sales trust. I'll stop calling it the magic trust. I'll call it the deferred sales trust. And as long as we use it for something other than ourselves, or if we use it for something business or reinvestment purpose, then we don't have to pay taxes on it now.
Correct. It's in a deferral state, right? Just like a 1031 exchanges, right? As long as you're moving into another property and you're following the rules, as long as you're following the rules here, you're not using it for personal use or personal consumption, right? And then it's in a deferral state. That is correct.
Okay. Now, if I do want money out of it, can I get access to it?
Yeah, absolutely. So every single trust is set up with a payment schedule that's set to pay you back slowly over time. And, typically we're at 5 to 6% interest payments, payout, but we're earning typically around 8%. But people could have, 8% payout, 10% payout, whatever they want. Typical actual earnings is somewhere between 5 and 8 based upon the risk tolerance. And you can schedule payments out, and we can also adjust that payment along the way. We just have to do some planning, and we have to just schedule that because it's a promissory note that we have in writing. That's what you own, is the asset is the promissory note that you have.
Okay. Now, should I want, let's say we do the boat, and my wife, who's here with us right now, Micah, she's blushing every now and then as we talk. She uses it for 2 years, taking clients out. They're fishing, they're having a good time. She takes about out a whole bunch of corporate people, and then she tells them that they need to come see me at the office later. I mean, it's a great little referral thing that's going on there. And then 2 years later, we decide that we want to keep the boat for ourselves. What do we do there?
Great question. So you can purchase the business back from the trust, and basically buy the interest of which the trust had in the boat business, and then you're welcome to do whatever you want with your business.
Oh, interesting. And then the trust would still keep that money.
Yeah, you just paid. You basically paid the trust back, right? So the trust was owed, was an owner with you in the business, and then you just bought the business back from the trust, and the money flows back into the trust.
Very cool. All right, now what if I'm scared about the market? Because Doug says that a lot of people they invest in the market in the trust until that next real estate deal comes along and they can buy something else. But what if I don't want to be in the market?
Great question. So the beauty of the deferred sales trust is there's no shotgun wedding like a 1031 exchange where you have to do a 45-day identification or 180-day close. And you can also diversify and dollar cost average into securities. The money can sit at the bank. Now, we do want to earn an interest on it, so we don't want to sit at the bank for too long. But everything must be approved by you, whether it be the investments and the timing of those investments. Okay. So also has to be approved by me, the trustee. This is part of how we make this all legitimate. So the answer is, when are you comfortable, Jake? And you might not be comfortable right away, but you could be, in a couple of weeks or a couple of months. And then the key is just getting dollar cost averaging and diversifying is typically what a lot of our clients find to be a great strategy.
Now, what are the controls on the trust? I mean, my wife, she likes to go buy me presents like all the time without me knowing. And she does little sneaky things like Amazon to her mom's house and all this other fun stuff, right? Does she have access to just pull money out of the trust without me knowing?
Yes, that's a good question. So how much control, do you have or does she have over the deferred sales trust? The answer is, to the extent that you are the lender and the trust is performing, that you have the ability either to foreclose on the collateral and take all the payments back, or per the promissory note. Now, the promissory note can be adjusted over time. And again, the payments can be adjusted over time, but it's not a demand note. A demand note would be something like unilateral control or 100% ownership of something. Or if let's say you walk to a bank and the bank said, "Hey, Mr. Jake Miller, you have $100,000 there. Your wife's on the account too," and she could walk in and say, $100,000, please, and they give it to her, right? There's nothing that's going to hold it back. In this scenario, there is that promissory note that's set to pay out, and that is the schedule, unless it's not performing, and then you have the rights and ability to foreclose and take the money back. So husband and wife would both have, if they're on the promissory note, they both would have those rights.
She can't do it without me knowing. Very good. All right. Now, Brett, let's just say something unforeseen happens, like the U.S. Congress and Senate decide on a 10% flat tax or 4% tax. Everybody becomes Puerto Rico. Can I just get all the money out? Can I just liquidate?
That's a great question. And this is back to the tax flow versus cash flow. So not only is tax flow about, offsetting cash flow with depreciation, but it's also about taking income in certain years or certain states or certain times when it makes sense for you. I'll give you an example of this. I had a client who sold an $8.3 million property, primary home in Palo Alto, moved to Nevada, and he had the promissory note start to pay him out when he was in Nevada and established residency. So to the extent that the interest that you're receiving is in a place like Puerto Rico that you've established residency, or Florida or Texas or Nevada, Tennessee, these really kind of lower tax income states, that's the tax you pay on the interest. Now on the capital, on the principal, you pay capital gains tax. You can't escape that. Whenever you dip into the principal, okay, you'll pay capital gains tax. But in that hypothetical scenario where the entire country went Puerto Rico style, or there was a zero tax holiday, we can refinance the trust or the promissory note, that is, to make a balloon payment in that given year. And guess what? You're walking away based upon that given year tax. That's kind of a power play. Now, the opposite is probably more likely. They're probably going to increase the capital gains tax rates, right? And that would mean you would have to actually pay more in tax. So be aware that, this can go both ways, and it's more likely to go higher. But that's also why most of our clients are keeping the principal, the golden goose, intact. They're never dipping into the principal. They're only ever living off the interest payments. That's the way we typically structure it.
Now, Doug told me something really interesting, Brett. Doug said, "Hey, Jake, don't think of Brett only as a trustee. He's a guy that helps you move in and out of assets. Or if I say that more clearly, he's a guy that helps you move in and out of assets most efficiently and oftentimes without paying taxes.
Yeah. So we work as a team, and part of my expertise and my background is commercial real estate. So I'm a commercial real estate expert. Think of me like a financial advisor for commercial real estate, whether that be investing in multifamily, mobile home parks, self-storage, whether that be development projects, whether that be syndications. That's my background. I grew up in the industry, grew up in my family, and then I went to Marcus and Millichap and learned a lot there. And I still practice brokerage as well for clients. So I'm still in the game and I invest myself. And so we like to say we want to try to help you create a dream team for the Deferred Sales Trust, where as a trustee, that is my primary role, but I'm also connected and very well educated in different investment opportunities. That's also why we bring in Jake Muller, who's the financial advisor here, because he's securities licensed and he's an expert on all those things, as well as an expert in real estate and different things as well. So that would be the answer, Jake. We really just want to come alongside and help to the extent that the client wants that. Now, some of the clients already know what they want. They're already experts in commercial real estate or businesses or even investing. And now we're here just to guide and support them in what they're looking to feel great about investing in.
Fantastic. Well, Brett, that was probably a good run with me being the client.
Okay. Yeah, it was.
How much more I can make up about being a client, because clients sometimes say silly things.
Yeah, no, that was really good. I want to open it up for anyone who has questions or comments on anything that we just went through on that, and any clarifying spots that you weren't sure about what Jake and I were talking about, or comments.
You know, I have to talk.
Yeah. Hey, Leah. What's up?
Hi. That was really great. I mean, that's exactly what I was hoping to hear from and to kind of learn from, like when you're in those situations. I just feel like I'm that type of person that learns better to hear it like as it's happening live. So, and I know you can't ever do anything live with these because, you know, the NDAs, but it was great. Hopefully you guys can do something else, you know, in the future too together again.
Absolutely. Absolutely. Excellent.
You know, I don't know that we're this talented, Leah, but I once saw whole life insurance as a musical. Now, I don't know if Brett has any hidden talents here, and maybe we could do the DST as a musical, but it all just depends how dramatic you want us to be.
And Leah too, do you have another scenario that you want us to do? Like that was just the client, you know, with me. Is there something that comes to mind where you're like,
I feel like you guys touched upon like several different objections in that call. So not right now, I don't have anything, but if something along, I'll definitely prompt you guys and let you know, hey, I have a script idea.
Okay, cool. Very good. Anyone else have any questions or thoughts on anything that Jake and I just went through? That was a role play, maybe a general call that we have every single day with potential clients. And if not, I'm happy to be the CPA, the skeptical CPA, Jake. Are you ready?
I'm ready. Let's do this.
Okay. So let's see here. Oftentimes too, let me just start it out. So, hey, Jake. Yeah. So I'm the skeptical CPA here, right? I'm very cautious and concerned that this thing is, you know, may not be legal. Like, I don't want to get my client into something that's, you know, not been really used or tested or known. In fact, I looked on the internet and I found some stuff that's concerning, right? Like I really need to see the documents, Jake, and I need to see the, you know, a private letter ruling and the court cases. And, you know, I just don't know that I can get behind this thing without really, you know, seeing everything, Jake. So like, how do you know this thing is legal, Jake?
That's a great question. Just for the fact that you're asking that question, it makes me feel more comfortable to talk with you, Brett. That shows that you really want to do what's best for your client and you want to protect them from some of the things out there that perhaps are not proven or not tried and true. With that being said, I felt the same way when I first heard about this and I started Googling. I found perhaps not as much information as I hoped to find right away just through Google. And I had to interview people. And the first people I found were trustees. Not all trustees are created equal. In fact, some trustees even gave me the wrong information, Brett. And so I was even more concerned at this point But eventually, somebody put me in touch with the law firm that created this. The very founder and creator himself, Todd Campbell. And after thorough discussions with other CPAs, financial advisors, and clients of mine, we had to sign an NDA. We went through this entire process, like pulled back the curtains and showed us everything, how it works inside and out. And I'll tell you that this is one of the most proven strategies and vetted legally that I could find out there. One other thing that might give you a little bit of confidence is that I kind of do this for a living, meaning, so you're a CPA and you might be a little bit skeptical about this strategy. That's good. Healthy skepticism is important. What do I mean by healthy skepticism? We need to somewhat doubt new information until we know where the source of the information is coming from. And until we can prove it, meaning that we've seen how it has worked for others, not just testimonials, because a lot of times testimonials are opinion-based. We want something that's factually based, which usually comes from court rulings, as you're very familiar with. You know, who and what sets a precedence in the court of law? Can you give me an example of maybe a precedence with maybe another tax topic?
You know, I don't know, but I read a letter on, and thank you, Jake, for all that. I think it makes sense. I read a letter, the franchise tax board, like, call these things illegal in California. Like, they sent this notice, and, you know, I got the thing right here. It's FT notice, and it says, it's talking about installment sales structures, and I'm really concerned that this isn't even allowed in California. Is that true?
Now, let's just look at that letter really quick. The installment sales structures. All right. And who put out that letter exactly?
That was the California Franchise Tax Board.
Mm-hmm. Yep, absolutely. Does that talk about deferred sales trust specifically?
No, it doesn't. It's true. Okay.
No, I mean, then that's all right. It's good and it's healthy. There are some people out there who take an additional how would you say, author's license above and beyond what they should to try to connect dots that shouldn't really connect. And they're trying to make a comparison with what we do, which might be a competitor to advice that they give clients, if that makes sense. So you might have biased information from some bloggers. Again, you have to find out what it is that they do for a living, what sources of information they are using, and if it actually relates. So just because somebody, you know, California Tax Board might say that they're scrutinizing installment sales, are they scrutinizing a deferred sales trust? I mean, it never in any one place talks about that. Are they scrutinizing a strategy that actually does appear on the IRS's Dirty Dozen list, which is called monetized installment sales? More than likely, they're referring to that, not to be confused with what we do. And so, a monetized installment sale, by the way, Brett, actually, when done correctly, follows certain loopholes in the code. But even though it could be something that could be accepted, we come back to what I was mentioning earlier. What precedence does the strategy have before the IRS? Now, the monetized installment sale, even though it could have been, and in some scenarios is a good strategy, it has been abused, meaning people didn't follow the same recipe. It's like making cookies with salt rather than sugar. Like it's similar, but somebody took their own, authoritative pen and they changed things up to their own liking, and it had a different outcome, of which the IRS has disallowed time and time and time again with the monetized installment sale. Fortunately, though, with the deferred sales trust, thousands of trusts later, over 2.5 decades later, we have 22 reviews or audits by the IRS, all of which have given a clean bill of health. Now, it is obvious that the IRS doesn't ever put a stamp of approval on anything, but they have never one time disallowed this strategy, and they have never one time reported any findings or any changes, which, if you're familiar with the IRS rulings and the IRS court proceedings and everything else like that, that almost never happens. Going back to the monetized installment sale, you have to weigh the pros and cons of when it's been audited, when it's been disallowed, when it hasn't, when it's been accepted. and decide, where does your client fit into the mix of that? Does your client's scenario work? Do you feel strong enough out of all of those that are being disallowed? Do you feel strong enough that you could promote or encourage them to use this strategy because their scenario fits on the few scenarios that have been accepted? Or with like a deferred sales trust, you typically.
Oh, shoot. Sorry, Jake. I meant to, I muted you accidentally, Jake. I meant to mute somebody else. Keep going.
Yeah. So with the deferred sales trust, the fact that it's never been disallowed gives you a wide array of comfort. Now, first, it's been tested several times, but has never been disallowed.
So can we do a quick lightning round on that? Because I hear what you're saying, Jake, and I'm actually starting to feel a little more comfortable. I didn't realize that. Yeah, so I was getting those confused. I was thinking like, yeah, they're all the same. And I was thinking like, because monetized installments, they'll use 453 and deferred sales trust uses 453. So it must kind of be on the same kind of mix. But I think I hear what you're saying. They're different. And one is on the dirty dozen list, and that's the monetized, and the deferred sales trust is not. And it's never been it had a single negative result, and it's 26-year track record, thousands of closes, billions under management. And there's, I think the biggest audit I also maybe heard on a different thing that's done in San Diego, $125 million deal, which is amazing. But is there a PLR, Jake?
You can actually get a PLR from the tax firm. So what we usually do is we take the clients and their advisors through a process. We have them sign an NDA because this is a proven and protected strategy. Proven and protected, meaning the IRS has tested a number of different times. It's never been disallowed. We like to maintain the integrity of it. We don't like just everybody out there thinking that they're a chef and letting them change the recipe, if that makes sense. It
makes sense, total sense, because you don't want someone to take it and then, either mess it up because they don't know what they're doing, and then it's a negative result. You want to make sure that it doesn't get hurt with the integrity that it has now. But yeah, there is a PLR, by the way, for those that are wondering. And there are outside third-party national law firms and CPA firms across the country who have vetted this. Movie stars that have used this, one of the $100 million deals. Law firms in California that did 3 months of due diligence. Some of the biggest and brightest financial advisors in the world. Companies that have reviewed this for multiple years and given it the thumbs up, the green light. So, okay, Jake, what about like audit defense? So because I'm a CPA, Jake, and I don't know. I can defend. I don't want to defend. I don't even know how to defend if I would. What's the chance that this thing gets audited? And then who's gonna provide it? Who's gonna pay for all that, Jake?
Great question. Now, first and foremost, for the other work that you do for your client, do you provide audit protection?
I don't know. Yeah, good question. Sure. For the stuff that, I'll charge for that, Jake. There could be additional hours, but if I file the tax return and they get audited, then I'm going to defend, the tax return, but there might be some additional charge to that. Yeah.
Okay. So you'll defend it. You'll provide some audit protection. You'll also charge for the additional hours, right? So the tax attorney and CPA behind this actually provides lifetime audit protection, and they don't necessarily charge for the hours, but they charge for the value. They do an upfront fee, and it's a legal fee based on their service. And that provides lifetime audit protection. Doesn't matter if it's 10 years down the road or whenever it is, as long as you're correctly utilizing the trust through a third-party unrelated trustee, the tax attorney and their firm will represent you before the IRS at zero additional cost to you. So you pay it all up front, and it's just a one-time transactional fee, but you receive the lifetime audit protection at zero additional cost in the future.
Okay, so as a CPA, I don't actually have to, worry about that. They're protected by another CPA who's the specialist. He's the brain surgeon. He's the ACL surgeon. I'm the general practitioner, if you will, in that sense. Or even, I could even be specialized in what I do. I just have never done the deferred sales trust, which is why I'm not as comfortable with it and why my clients coming to me. And it's hard for me to say, oh yeah, here's a green light, because Jake, there's not a lot of upside for me. Like if I say, great, this looks good, but I've never done it and I never had a client do it and it works out, well then great, that's okay. But if it doesn't work out, now my reputation and mine's on the line. So this is why I'm super, super cautious and more likely just to tell them, I probably wouldn't do it. In fact, stopping the whole role play now here too, right? So this is really interesting, Jake. So I had go ahead. You want a thought?
I would just add that for being another professional, the law firm is essentially indemnifying you for all advice provided in regards to the deferred sales trust because they are taking all of that on themselves. They will be the ones that put the stop. Even if you are saying, hey, you should do this, you should do this, you should do this, Mr. Client, they'll put the stop and say, no, you shouldn't do this if they shouldn't do it. Or assuming that you're correct and your advice is warranted, they are taking the responsibility for all things deferred sales trust on them. And that's why they charge that upfront fee.
Perfect. Yeah. And then here's another kind of a deal. Actually, this week, the client decided to move forward after extensive talks with the CPA and going through it in detail with our tax team and all of it. And it was interesting. I said, well, how did it go? Because he came down to these numbers, and these numbers were pretty amazing. He had about a $10 million sale. He had about $5 million of debt. And he had about $2.5 million of tax liability, and about $5 million was going to hit the trust, and $2.5 million was going to be deferred. So he was either going to have 50% more or 50% less. Okay, and so we go through the detail of the CPA, and he seemed to be very open-minded, but he brought it to the conclusion. Like, I had a last call and then a last call with the CPA, and he basically said, Mr. CPA, what do you think? He goes, well, I could see the numbers. He goes, yeah, the numbers make sense. Like, you're going to have an extra $2.5 million, 50% more in your retirement. You're going to be able to hit your cash flow needs. You're going to be able to live more comfortably. You can be more conservative in the investments. He goes, but I wouldn't do it. And he goes, oh, you wouldn't do it? Why not? He's like, well, I probably would. I would want to keep it just simple and just pay the tax. And we kind of laughed, me and the client, because it's the same. It's a very common theme. It's like, it's easy for the CPA to say, I wouldn't do it, right? I wouldn't do it because he's not the one paying the $2.5 million of tax, right? And so it's like, the evidence is like thousands of closes, billions under management, perfect track record, lifetime audit defense. We're not having any pressure on the CPA, but the CPA is still taking the super conservative spot. I wouldn't do it. It's like, well, everyone's a skeptic until it's like Mike Tyson said, everyone has a plan until they get hit in the face with $1 million tax bill. And so he's going to do it, fortunately, but we're not surprised when the CPA is cautious and skeptical. Now, 99% of the time, they actually join us. They end up sending us referrals, but we're also not asking them to become the judge, juror, and executioner, or the IRS on this. We're only asking them to come in and keep an open mind with it. Now, we have gone to the extent where sometimes clients just say, fine, I'm going to go with the CPA. I mean, Brett, give me a CPA firm that's done this for 50 years. Great, here it is, right? And let's go do the tax returns there. We don't ever like taking that route. But if it gets to the point where they're just so adamant that they won't even want to file on the tax return, by the way, it's typically Form 8832. It's an installment sale form. It's the same form that you file a traditional installment sale on. So it's not like it's some special form or some special thing. It's just an installment sale. So that being said, Jake, great job. Any last comments on any of what I just said?
Just that every client is different, and some professionals and some clients work really well with us, and they don't view us as competition. They view us as the experts in something very specific that we fill in the gaps for them and we help them. Others are a little bit more combative, a little bit more closed-minded. Some don't want to sign an NDA, and with those people we just can't work with. It ends up being difficult. I've actually had some clients who have fired their other advisors so that they could work with us, which they've been with these other advisors for years, and they only just now started to know us. And this was the straw that broke the camel's back, so to speak, and the last they wanted to see of those people. And we're not here to break relationships. We're here to build and cement and solidify them, and more than happy to help other advisors with their clients do that.
Exactly. That about wraps it up for today. If anyone has any questions, we do have like a couple minutes left for anything that we just said. And by the way, you can invite everyone next week and go to capitalgainstaxsolutions.com and register for the free mastermind. It happens every Friday, 10 a.m. Pacific Standard Time, 1 p.m. Eastern. But we really want to encourage everybody to come on and wrestle with the trust, with us, with the questions, with the concerns. Bring on your CPA, because you have one opportunity, right? We cannot close the trust after a deal has closed. In fact, that's where it's too late. It's even too late if the buyers remove all contingencies. The only time we have another second window opportunity is with a 1031 exchange, which remember only qualifies for investment real estate. But even then, if you're with a qualified intermediary, that does not allow the deferred sales trust, then you're stuck in 1031 jail over there. So you also want to get with us so we can give you a strategic alliance that does allow both a traditional 1031, Delaware statutory trust, and a deferred sales trust. That being said, does anyone have any last questions for Jake or I at this time?
Where can we get the merch? Tax flow, not just cash flow.
Oh, good question. Yeah. We don't have a store quite yet. This is our first one. Check out the back here too. So yeah, so that's that. And then we have another one that says friends don't let friends overpay for a 1031 exchange. I don't know. I got to get my team on that. So, but if you come to the live event in Dallas, Texas, by the way, next week, I am giving out some free shirts. See me at an event in Las Vegas is the next one in October. Everyone's invited. You can probably get a free shirt.
I will be there. We're in what day on Dallas? What's the detail? The Dallas
Tuesday
event?
to Thursday, Dallas, Texas. Tony Robbins is on Thursday. Big dinner on Wednesday. We're going to be touring a property on Thursday, a big investment opportunity. We'll be masterminding with, some rock star real estate professionals, investors, all at the Dallas Fort Worth Gaylord Texan Resort.
I'll be there.
Sweet, Leon. That's awesome. I'm so glad you're coming. Anybody else? Questions, thoughts, comments for Jake or I? Cool. Jake, we did pretty good. Jake, if people want to find you, where can they find you?
strategictaxsolutions.com, 1-800. Where's my phone number? 1-800-773-1848.
Excellent. And if people want to find me, you can go to capitalgainstaxsolutions.com. That's capitalgainstaxsolutions.com. Make sure to rate, review, subscribe to the YouTube channel. Please share this with someone that can inspire today. Maybe get a little comic relief with some of the role play. And remember that the not having a plan when you exit is the enemy, right? And using a proven tax deferral strategy such as the deferred sales trust to defer 25 to 50% in capital gains tax and depreciation and recapture is an amazing way for to exit crypto businesses, highly appreciated real estate, save a failed 1031 exchange. But you got to have a plan, you got to have a team, and you got to be able to execute. And that's what we're here to help you do. So go to capitalgainstaxsolutions.com. Please join us next week. Please invite somebody. We will talk to everyone real soon. Thanks, everyone.